And now let's talk about China. A tsunami has hit the Chinese economy. It came in the form of a report, an assessment from ratings agency Moody's. They've downgraded China, and now Beijing is trying to downplay it.
The fundamentals of China's long-term economic growth have not and will not change. We are confident and capable of achieving long-term stable development.
The verbal attacks did not help. The report proved to be devastating. Investors are making a beeline to exit China. Today, Hong Kong witnessed a mass sell-off. Companies in the Hang Seng Index are taking a beating. They're approaching a 13-month low.
I think sentiment has been extremely fragile over the past 3 years. And we see investors reacting quite strongly to any negative headline. So you saw equity markets in particular correcting very strongly.
The yuan too is having a tough time. For 2 days now, its value has been falling. Beijing was forced to make an intervention. China's state-owned banks were asked to step up and defend the yuan. They're selling US dollars from their reserves and buying the yuan from foreign exchanges. And they've been doing this for the past 2 days. Today, China released export data from the month of November, and for the first time in 6 months, Chinese exports have grown. But this is one good headline amid a deluge of bad news. The Moody's report is an indictment. It confirms what experts have always known. China's economy faces fundamental problems. It's a bit like long COVID. There is a lingering illness. The symptoms are stubborn and they're not going away. The available cures are not working. Plus, there is the issue of trust. Reports say before releasing this latest assessment, Moody's officials sent a message to their staff. Their employees working in China, they got a message. They were asked to work from home, to not show up in office. Why? Apparently, Moody's was afraid of a government backlash. As it is, foreign companies face harassment in China. An adverse report on the Chinese economy would make them more vulnerable. In recent months, Chinese authorities have raided them and detained their staff. And which companies have been targeted? It's a long list, including names like Foxconn, Capvision, Brain & Company, and the Mintz Group. China has raided all of them. Now, Moody's is afraid it could be next. But what explains this intensifying scrutiny? What's driving these raids and detentions in China? Beijing wants to muzzle the critics, stop accurate data from flowing out, and control the narrative on their economy. That's classic China for you. When confronted with criticism, they crack down. On most occasions, the strategy works, but this time, it's not working. The crackdown came too late. The cat is out of the bag. There is a cash crunch across the board, starting with the government itself. Chinese cities and provinces owe trillions of dollars in debt, and they're struggling to service this debt. We've talked about this before, and now there is fresh data. Data about the size of Chinese government debt. How much do China's local governments owe? Anywhere between $7 to $11 trillion. That's the estimate of the International Monetary Fund and Wall Street banks, up to $11 trillion of debt. A significant chunk of these loans are risky, and the value of this debt is anywhere between $400 and $800 billion. We do not have exact figures because China is not transparent with data, so these are estimates. These loans are classified as high risk, meaning local governments may struggle to repay them. They may even default. So there is a significant debt burden and a shortage of cash. How would you respond to a situation like this? You don't have to be a financial expert. All you need is common sense. Cut expenses, raise earnings, and try to renegotiate the terms of your debt. That's what most people and most countries would do. Not China, though. When China faces a financial crunch, it responds by issuing more debt. And that's what local governments in China are doing. This year, they have sold a record number of special bonds. Do you know how much money they raised? More than $21 billion and counting. And this money is to save multiple small and medium banks, the ones under strain, the ones running low on cash. There are very many of them. So Chinese officials are raising funds and using new loans to recapitalize banks. Last month, some state-owned banks raised money too. Reports say there was a liquidity squeeze. Banks needed more money to service short-term obligations. So they decided to borrow. Now, what does all of this tell you? China's entire financial system is fragile, it is addicted to debt and surviving on a continuous cycle of borrowing. One default can trigger a storm, and the devastation will be felt way beyond China.